Hello, everyone. 7 Investing CEO Simon Erickson here, and thank you for listening to the 7 Investing Podcast. Our podcast is made possible by our subscribers, who allow us to empower you to invest in your future each and every month. In exchange, we give our subscribers exclusive access to our monthly stock market recommendations from each of our lead advisors. To support this podcast and join other 7 Investing fans in our exclusive Subscribers Forum, where we discuss the latest market moves in real time, go to 7investing.com/subscribe to subscribe to 7 Investing today. We're here to empower you to invest in your future. We are 7 Investing. Hello, everyone, and welcome to this edition of the 7 Investing Podcast, where it's our mission to empower you to invest in your future. You can learn more about our long-term investing approach and see our favorite stock market opportunities each and every month at 7investing.com. My name is Simon Erickson. I'm very excited to welcome my guest to the program today. Todd Wenning is a lifelong investment analyst. He's worked on the buy side, he's worked on the sell side, he's worked on the retail side, and he's now the founder and writer of Flyover Stocks, which is a newsletter you can find out more about at flyoverstocks.com. Also joining us today from up in Ohio, Todd, welcome to the 7 Investing Podcast.
Hey, thanks, Simon. Great to be here.
Now, Todd, can you tell us a little bit about the name of the newsletter? I know that's kind of in some ways a tribute to Ohio, but what led you to do this? And also tell us a little bit about your background, if you would.
Sure. So, Flyover Stocks was a combination of a couple different things. One, I'm about 40 miles south of Dayton, Ohio, where the Wright brothers are from. And, my wife's family is down on the Outer Banks of North Carolina, where they did the first flight. And so that I have that association. That was part of it. That's also the inspiration for my logo, which is the original Wright flyer. Also, I think when I was at Morningstar, I wrote a series of articles called Seeking Small Cap Moats. And really, these are stocks that I thought had economic moats, but weren't being talked about. We didn't cover them formally. And so I thought that was a great kind of premise to think about, or a framework to think about finding opportunities in companies that aren't discussed a lot in popular circles and are nevertheless really strong companies. I actually went back and looked at the series of stocks that I discussed from 2013 to 2015 at Morningstar, and of the 16 companies, 6 of them went on to be acquired, and 3 of them went on to have over 400% returns through August 2015, August 15th, 2023. And so that to me is a pretty interesting signal that even though I wasn't doing any in-depth work on it in terms of valuation, just kind of highlighting these flown over stocks that have been kind of ignored by the broader market can produce some great results. And you find some really interesting companies, for the companies that got acquired, the acquiring business thought they had a great asset and otherwise they went on to do great things. And there were some flops in there for sure, but there were also some really good producers, like Winmark was one of them, Badger Meter was another one. So there's a couple of companies in there that people wouldn't have really thought about, just looking through the Wall Street Journal every day, but nevertheless went on to do very well.
Yeah. And Todd, you are a very in-depth and thorough analyst. Like you mentioned, writing on behalf of retail investors, kind of looking at things a little differently on the institutional side of it. I do like how you framed your goals for Flyover Stocks. You've said that you're looking for overlooked quality companies led by thoughtful stewards of shareholder capital. Of course, each one of those words in that means something. And I'd like to maybe dig a couple layers deeper into the onion here in this conversation. You put out a couple of years ago, a kind of a neat Venn diagram, maybe to frame this, where you've got the 3 circles. For everyone who knows the Venn diagram, there's kind of 3 circles for what you look for strong buy opportunities. And you've labeled them as management, moat, and price. And so perhaps for this conversation, let's dig into those a little bit deeper for each one of them. And then also maybe talk about a couple of companies that are intriguing or at least worthy of putting on your watch list. But the first is the moat part of it. I know that you've written expansively about moats over the years, but how do you actually identify a good business? What stands out as a strong moat for a company?
I think the easiest way to think about moats, and we can talk about the different sources, whether it's network effects or switching costs, whatever it might be. But if you're just a non-professional investor and you're looking at a company, the question you need to ask yourself is, what is this company's unfair advantage? what can they do sustainably that their competitors can't do? It might be that they have a network of service terminals that would take 10 years for someone to replicate. It might be that they have some intellectual property that's patented. It might be something that just makes it really difficult for anybody, either a larger company or a smaller company or a startup company, to eat away at its profits. And so that's the moat part of it. And I think a lot of investors look at that and they might say, "That's great. It's got a moat. It's good for a long time." But what often happens, the reason that moats erode, in my experience, is primarily what happens on the inside of the business. We typically hear about companies falling apart, and the reason is because of new technology or it's a new competitor, whatever it might be. But all that starts behind the castle walls, to kind of continue that analogy that Warren Buffett coined. It starts with management not thinking long term for whatever reason, or they're not agile, they're not responding to new technology, they're not there's a culture of continuing the inertia of what they've been doing. It's been very successful. Why should we disrupt ourselves? And so that sort of snowballs over time, and it creates a very toxic internal culture, and that just opens the door for competitors to eat away at that moat over time. So I think a lot of competitive analysis, a lot of competitive strength analysis is focused on, okay, how does this company fit in with competitors, external threats? But I think you also need to spend a lot of time thinking about management and how they're allocating capital, how they're creating a vibrant internal community where people can thrive in their careers and help deliver on a purpose or a mission that's bigger than themselves.
Let's double click on that a little bit, because the concept of moat is fairly easy to comprehend, but then it's a little bit harder. Actually, it's a lot harder to actually quantify and dig into. The thing that you mentioned that I'd like to talk a little bit more about is capital allocation. We're talking about internal management decisions. Say you go and you find a great company that has got a moat. It's capturing profit margins. It's capturing, operating efficiencies. The business itself is fine, but that's only one part of it, right? Now management has to figure out, what are they going to do with that profit stream for the good of investors? And so when you mention capital allocation, I know that you and I have chatted before about dividends, and that you've written a lot about dividends, but there's kind of different options aligned with what the business itself is, and then kind of, what the type of moat is. You've referred to this as a reinvestment versus a legacy moat in some of the things that you've written about, but how do you think about that? The tie between the moat of the business, the profits of the business, and then the capital allocation of what to do with that from a management team.
Sure. So there's a really strong link between moat and management and how to think about it. So one way to visualize a moat is, so to have a moat, you have to be generating returns on invested capital above your cost of capital. And so one way to think about it is, you have like a printer, and if you put $100 into the machine, and let's say it spits out a 15% return, you get out $115, but it costs you $8 to run the machine, and you got 107, right? And now you can take that and reinvest it over time. And so when that happens, you want to be continuing to put money back into the machine as much as you possibly can. And that's to me a reinvestment mode. Legacy mode is when you don't have the opportunities to reinvest back into that business and continue to generate that spread over cost of capital. And so in that situation, to the extent, and not every company, it's not like, for most companies, it's not like a 0% or 100% reinvestment rate. Every company is probably usually somewhere in between. Like, especially for a more established company, they might have 40% to reinvest in the business, but the other 60% that has to get allocated. Whether that's opening the door to M&A, that's opening the door to dividends and repurchases. And so how management prioritizes those things, the reinvestment, the dividends, the share buybacks, or the M&A, is of utmost importance. I mean, we all know stories of disastrous transformational M&A deals, and that just can really, again, going back to what I said before about the moats eroding behind the castle walls, is that major acquisition, transformational, management get distracted. Maybe they're dealing with antitrust or whatever, and so it can become a very very distracting time, and that can open up an opportunity for competitors to eat away at the moat. And so again, that all comes back to, that connection between management and moat. The moat provides the cash flow to management, and then it's up to management to reallocate that capital in a way that perpetuates the moat, and obviously, hopefully makes it wider over time rather than narrower.
Yeah, and if we go back a couple of decades, this is kind of now blurring the line between moat and management, but the kind of the middle ground there is you go back a couple of decades, it seemed to be like dividends were the way to return capital to shareholders, right? Companies would go out, produce profits, pay it back out to their investors in the form of cold hard cash. We've certainly seen in the digital age M&A picking up a lot more, and it seems like technology with AI and everything else we're talking about in the headlines right now is progressing that pace of innovation even faster now. How do you think about dividends now, Todd? Are there certain companies that should still always be paying dividends, or is this a different era that is a little different, that companies don't choose dividends as an allocation strategy anymore?
Yeah, I think dividends continue to be the strongest signal to investors that the board is confident in the coming years, because this is, in our system, typically it's a progressive dividend policy. So in other parts of the country, or other parts of the world, excuse me, they might have like a flexible dividend policy where they pay 40% of net income that year. And net income might be low, it might be high, but you're getting 40% of that. Whereas in the United States and UK and some other markets and other companies, it's a more progressive dividend policy. So they're raising their dividend each year with the expectation that they'll be able to continue to pay that through cash flow and earnings over the next 5, 10 years and beyond. Because what you don't want as a board or the management team is to have to cut the dividend or not grow it. So that helps, investors to identify, companies and boards that are confident. Now that confidence may be misplaced, right? And that's our job as investors to decide whether or not that's a smart move. But that's, to me, a great signal of a growing dividend, is that the board continues to be confident in their ability to pay at least that much over the next 5 years, which means that they expect earnings and cash flows to be at least similar to today. And so that's a very good signal. Whereas with buybacks, there's less of a commitment implied. So, you can one year pay $2 billion, the next year do nothing. And so there's not a lot of signal in that. Someone might say, well, if you think they're buying back the stock at a good price, that's a good signal that the stock is undervalued, but it doesn't really tell you necessarily as much, to me at least, as a dividend does with their expectations of future cash flow. Because the next year they might stop the buyback and do an M&A deal, and to increase their sales, increase their earnings, increase their incentives, or their financial incentives, or whatever it might be. So there's different reasons for that. But I think dividends also are a way to shrink the size of the sandbox that management has to play in, is the phrase that I often use with dividends. And that's not to say that, you don't want management to do anything, in terms of, you want to tie their hands, but by rationing the amount of cash flow that's available to them in a given year, they have to be a lot more thoughtful about how they're reinvesting. They don't have an empty, a blank check. They have to really think through, okay, I've got, whatever it is, 40% of cash flow this year to make, buyback decisions or do M&A deals. They got to be really thoughtful about that. There was a great paper done. It's been a while. So the data may need to be refreshed, but there was an article by Rob Arnott and Cliff Asness. The title is Surprise Higher Dividend Payouts Lead to Higher Earnings Growth. And one of their theories was just that the management teams have a smaller sandbox to play with. And so they have to be more thoughtful about how they allocate the remaining cash flow. And so I think I've heard great arguments for buybacks. To me, I see the value in them. I'm not anti-buyback. I've invested in companies that only did buybacks, but I think dividends continue to be a very relevant way to signal to investors that the company has cash right? And they're generating cash flow because you can't pay out earnings, you have to pay out cash flow. And so that's a real another important thing to think about when looking at a dividend payer versus another a non-dividend payer.
Yeah. And is there a sweet spot you look for, Todd, when you're looking for a dividend payer? You're looking for a company that's maybe paying a 2 or 3% dividend that's still growing 10 or 15% per year, or you're looking for a higher payout, maybe a 5 or 6% that's growing in single digits, or it doesn't matter either way?
Well, to me, the market doesn't give away free yield. Right? There's a trade-off. There should be a trade-off, whatever the situation is. So if a company is yielding 6 to 8%, the market's not just going to give you a free 6 to 8%. There's a trade-off there somewhere along the lines. Either it's low future dividend growth, or there's something going on with the company where the future cash flows are in question. Um, and on the other hand, a super low dividend yield doesn't really give you much income. So to me, it's a balance. I think, if you were looking to set up a dividend portfolio, starting in the middle and working your ways outwards is probably the best way to do it. The 2 to 3% dividend yielders. And again, it comes back to your confidence in the moat, right? And that's one key thing about dividend investing is you have to be confident in the moat, which provides the company with the ability to generate the cash flows that'll help you, that will increase your payouts, for years to come. So it's all related and linked. So even though I wouldn't consider myself a dividend investor, the way I might have in the past, I continue to think that it's an incredibly important part of thinking through businesses and using the other tools at our disposal, like mode analysis and management analysis, to think through how dividends might play out and how it might benefit our portfolios.
Yeah. And then the final piece then, Todd, would be the external, the investor. The third part of the Venn diagram is price, right? We talked about the mo, we talked about the management. Now, what's the right price to pay for a stock? I'd like to hear your thoughts on that personally first, or in a minute. But first, since you've seen the buy side, you've seen the sell side, you've seen the retail side of it, can you maybe introduce this by broadly talking about how retail investors think about the right price or how to value a company? Is that any different than how institutions tend to price a company and figure out what's a good bargain, and then kind of maybe settle it up with how you personally think about the right price to get in it?
Sure. So I would say there's sometimes there's commonalities. It really depends on what the investors are trying to do, whether it's retail or an institutional investor. I would say for most quality long-term investing institutions, they all use discounted cash flow models, and then that helps them inform how they think about the valuation. On the other side of that is multiples, right? So the PE is this, the price to book is this, and that's really a shorthand for what the market's implying. And so that's a key thing I think that gets misunderstood, is that a PE is just an implied DCF. And so I think to the extent that you can grow comfortable and skillful at modeling companies in the future, that will help you understand what's going into the multiples in the market today. I really recommend Michael Mobison's book called Expectations Investing, which I think is a great entry point for people to, he explains things so well. And, what he's trying to do in that book is help you understand what's priced into the stock through a DCF model. So here's some assumptions. Here's how, the discount rate, the net operating profit after tax, and NOPAT, and that all kind of goes into what's priced into the stock today. And then you can make a decision to say, I think that's too low, or that might be too aggressive for my taste based on what I think about it. So I think either way, I think one of the reasons that DCFs are so valuable is that they are explicit. And, like any model, they're flawed, right? There are flaws with everything. There's downsides to everything. But I do think one of the key advantages is being able to explicitly see, okay, the market is down 30% on the stock. What does that imply about the out years? Because that's really where, I think there's and I used to subscribe to this theory, and I changed my mind on it. Is that the market is so short term, and it's not. What's really happening is that the market is adjusting its long term outlook on the company based on near term information. So they're if they're doing it intentionally or not, what they're saying is that I now have doubts about how this company is going to look in 10 years because when you run DCFs, it will show you that the bulk of the company's value is in the out years. What your terminal assumptions are, and so if that changes, if the risk goes up about discount rate goes up, or the expected cash flows go down because of concerns about competition and eroding moat, that's why the stock's down, right? And so, to the extent that you can continue to have conviction in that long term outlook for the business, you can say that I think it's undervalued, and here's why. I think the long term relevance of this business will play out in the end. So I think that's one way to do it. Again, so I think multiples are fine for what they are, but just understand that they're implied DCFs. And so having explicit forecasts, you can make changes, you can, alter your outlook without trying to say, is this PE right? You can actually see, okay, margins are coming down. What does that mean? Sales are implied going down. What does that mean? And so you can start asking questions. And I think it's a great way to also grow as an investor and experience is, thinking through those unit level economics of the business. So, sales per store or profitability per store, thinking through those metrics and, trying to understand the business at a deeper level than what you might get from just using back of the envelope PEs.
Yeah, that's some great insight. So you see a stock that sells off 30% by missing earnings by a couple of pennies. It's so easy to dismiss it like, oh, geez, this is a short-term hiccup. Obviously, the company's just fine. This is a buying opportunity, knee-jerk reaction. You're saying there's actually a couple layers deeper than that of why was the expectation off? Why did the company not hit what it was kind of transparently forecasting to do? There's a couple layers deep to that, though. You're just saying it's more in the out years than just in the quarter that we're looking at right now.
That's right. There's an expectation of, if a stock falls 30, 40%, it's not because they missed earnings. It's what the guidance was or what the expectations, in the market have changed. That, guidance is down, and that implies that competition has increased or whatever it might be. So to the extent you can think through that, it is really the key to identifying when the market might be wrong. Might be a great time to take a position in stock that you've been following for a long time. But the market's not stupid. There are times where there's emotions take over and crazy things happen. But all in all, the market's pretty rational when it comes to thinking through challenges. And so sometimes those are overblown, sometimes they're wrong. But our job as investors is to have conviction in that long term outlook that we believe in. And you either believe it or you don't. If you don't believe it, then you get out. So I think that's really the key to thinking through some of those big drops in the market or in individual stocks is just thinking through, to have that conviction going in, because you can't build conviction in a crisis, right? You build a conviction ahead of time. You get to know management, you get to know the product, the service, what the offering is, what the value is. And then when the crisis happens, you can say, okay, I'm going to stand behind this, or something really has changed and I need to get out. So I think that's a constant challenge for investors to process, especially when in times of market volatility.
That's a great point. Now, I have one more question before we jump into some companies, that the investors can put on their watch list. But can you jump at what we're talking about this? Can you chat a little bit more about how you've seen the institutional market, I guess, embrace innovation or like think about risk? Because, we know that it's challenging sometimes if you're running a fund. You don't want to stick your neck out too far and take a huge risk on something that is still uncertain or unproven. But there is innovation and things do happen fast. And of course, you want exposure to that. We've certainly seen as retail investors, growth style investors are often eager to kind of get at the cutting edge of what's new out there. But we're not dealing most of the time with hundreds of millions or billions of dollars like institutions are. Could you maybe chat a little bit about how institutions think about, innovation and stuff that is not as established, not paying dividends, not a sure thing with a strong moat, but how does it go after the growth style companies out there?
Well, I think especially if you're I would say a growth minded investor, again, the value is in the out years. And so thinking about how innovation today might impact long-term value creation is so critical. Just for example, thinking about autonomous vehicles. If you have autonomous taxis, what does that mean for Starbucks, right? Will Starbucks have drive-throughs? Will it need drive-throughs? How might that change the stores and how they're set up? And you can kind of see that already with a lot of the digital only type of stores. Maybe they're planning for that. Will they have, ads coming in to the taxis, to say, hey, you can get $1 off your ride if you stop at Starbucks or whatever it might be. So I think any serious investor who is concerned about long-term value creation has to think about innovations. Okay, well, like, is this really a game changer or not? And a lot of times it's too early to tell. But I think you need to be sensitive to that, because once it becomes clear to the market that something is changing, they'll sell way before it becomes like completely revolutionary. You'll see the market respond because all of a sudden it becomes apparent. Even if it's like, let's say 2 or 3% penetrated, something's happening here. We need to, again, thinking about the long term, sell down the position at the very least until we have more confidence. So I think any serious long-term investor has to think about the technological risks, but also understand, especially if you're invested in thoughtful, driven companies, they're going to react and respond to that. So, if you're Starbucks or whatever it might be, they've been on the cutting edge of technology for a long time. They were early in the mobile payments and they were early in different things. And I have no position in Starbucks, by the way. It's just one that I remember off the top of my head. But, they're going to respond to it, and they're going to try to make it work for them. So just to sell just because, oh, well, that's going to change things, that's not a great approach either. You need to think about, how willing would this company be to disrupt itself or to adjust? Because if you're in a very calcified business and technology comes along, well, it's going to be easy pickings, right? So you have to find companies that are willing to change and adapt. And if you look at a lot of the incumbents, a lot of the winners from the internet age, it was the incumbents, right, who adapted into Web 2.0 and adapted. I mean, for every Uber, there's a Procter and Gamble, right, who use the internet to its benefit. So I think you just have to be confident in the company's ability to respond to change. If not, you need to have either a smaller position or not be in a position at all.
Yeah. Netflix versus Blockbuster. Great point. Let's chat about a couple companies here. Again, disclaimer, these are not necessarily strong buys or endorsements from Todd, but just some ideas for the watch list. One that you've covered for a long time is Costco. Tell us a little bit about this company. I think we know it pretty well, but what's interesting for investors about this one?
I think, Costco is one of those stores everyone kind of knows about. It's a great company, et cetera, et cetera. But it's such a wonderful business that it's really hard to understate that. Their annual report is 86 pages long. That's it. It's an extremely simple business. And if you are just starting out as an investor or you're just starting to do financial modeling, it's the prime one to look at, in my opinion. It's just so simple and so consistent. I mean, they have the store cohorts, average sales, and it's the same table every year that goes all the way back to like 1997 or whatever it was. And it's just they're not changing segments. They're not, and so it's a very clean accounting. Charlie Munger, I forget the exact quote, but he basically said, if you're ever in doubt about the world, just think about what Costco is doing. Right. And so I would really recommend people look at Costco if they haven't already, or to think about it in a different way. I mean, they're doing some incredible things with executive memberships, getting people to upgrade from the basic gold membership to the executive. And I think it's something like 4 times. Executive members spend about 4 times more than gold members, and because they get the cash back. If you think about their growth runway internationally, it's very, very strong. And they are slow but methodical about how they grow internationally. So even though I would say most companies, if they had the opportunity set that Costco had, they would aggressively run out build as many warehouses as possible, try to have the first mover advantage in some of these markets. But they're taking their time. It's key to them to build up the supply chain and the supplier relationships so that they can leverage their strength to get lower prices for their members. And you see that in China, they started with one store and they had like, I don't know, there's well over 100,000 members sign up for that store. And then like that weekend, it's incredible. And now they're opening, I think, two more in China in the next 12 months if they haven't already. But they're just a great business, to study and to listen to. They have monthly sales updates, and I think they're just incredibly transparent. It's a great company to learn about. It's a stock that I've owned for a long time in my portfolio.
And then how about one that's a little bit less known, maybe to a lot of investors in our audience, Worthington Industries, industrial company that you followed.
Yeah, so this was a company, the first one I profiled in Flyover Stocks, and it really it resonated with me in a number of ways. It's just up the road in Columbus, not too far from me. But it's also a company with a rare sort of spinoff story. So typically, when you hear about spinoff opportunities, it's the new company, the one that's getting spun off that people are interested in. That typically gets sold off after it gets spun off because the existing shareholders of the remaining company they don't want that piece, and so they sell it and they keep the remaining company. But here they're doing the opposite. Worthington's getting rid of the legacy business, which is their steel processing business. And I've looked at Ohio-based companies again and again and again over time, and I've never looked at Worthington before until a couple of weeks ago. And it was because it was a steel processing company. And I was on the basic materials desk at Morningstar from 2011 to 2015, and I saw firsthand what happens with steel prices. Plummeted for basically 4 straight years after the China boom, and there weren't a lot of moats there, and so I just wasn't interested. But Worthington is spinning off the steel processing business, and it's keeping a much smaller consumer products, building products business, and it's higher margin. It's much steadier business, not as cyclical as the steel processing business. The stock has been priced for a long time like a steel stock, trading less than one times sales, very volatile. And so by kind of getting rid of that volatile element and focusing more on the stable, more steady, niche type of business with great margins, they can really create this cash flow machine. And one of the other things I really liked about the opportunity is that Andy Rose, the CEO, who started in the CEO role in 2020, but he came onto the scene in 2008 as the CFO. And since he's been the CFO, they retired about 40% of their shares with it, which is hard to do when you're running a steel business and you don't know, again, going back to, flexibility with cash flows, to be able to retire 40% of the stock over the last 14 years, it's a pretty good run. And so if he's given a more stable cash flow business, that could mean more M&A. He said he's done 60 M&A deals in his career, 20 of them at Worthington. So he comes from that background, and it strikes me as a potential kind of outsider CEO who can come in and really do some create some value. So that to me is a great opportunity. The balance sheet's very strong. They've been paying down debt and holding more cash going into this spinoff, which is supposed to happen in early 2024. So it's just a really intriguing story to me. So in their consumer products business, they make like propane tanks and gas tanks and things like that, which are not very sexy type of business. But they have a strong relationship with Home Depot. I believe they just raised their price with Home Depot, and Home Depot, it wasn't like a big deal. They didn't have them cut price, so that relationship is very strong. You can think about the propane tank business; that's a big traffic driver for Home Depot. So it's a strong relationship they have. On the building side, they have got some good joint ventures. One of which is called Wave, and that's with Armstrong. And so if you think about the acoustic ceilings you have in offices and in various buildings that have, the checkerboard. So Worthington makes the steel beams that go into that sort of checkerboard pattern. And it's a whole system where it makes it easier to install, and the builders can get on to the next project. And so it's a great business, great profit margins, and it's very steady. One of the concerns I had was, well, we've had this building boom. What happens next? But the profitability and the growth has been there since before the pandemic. So that joint venture called Wave is a very strong contributor, and I expect it to be in the coming years for that business. So that's one to look at. If you're interested in smaller businesses, and kind of spin-off stories, it's an intriguing one, and I've got a lot more written up on my site if you want to take a look.
Yeah. Any other final thoughts? It's an interesting time out there, crazy macro. We talked a lot ad nauseum last year or two, Todd, but any other final thoughts for retail investors that are looking to buy some stocks out there?
Think you just need to stay focused on the business. If you think about home builders, right? If you had talked to home builders in fall of 2022 and told them what the macro setup would be today with higher interest rates, cooling jobs, they would be like, okay, we're not going to have a very good 2023, and it's been gangbusters for the home builders. So, you know, I minored in economics as in college, and none of this was in the textbook, right? And it's just so to spend a lot of time on macro. I think this is a pretty common phrase that Peter Lynch used. It's basically you're spinning your wheels. You're not generating a lot of insight from that. Worrying about inflation or interest rates. I mean, those are fact of the matter. And again, going back to having faith in management. Can they respond to different markets? Can they do you trust them to respond and make the right decisions? Do they have pricing power? Can they pass on higher costs? And these are all questions that if you can answer yes to all those questions, you shouldn't be too worried about what the macro environment's doing. If anything, these companies will get stronger in downturns. The weaker hands fall away. The weaker hands are worried about how do we preserve capital, and the strong ones are investing through the cycle. This is another company that that's off the top of my head, but Old Dominion Freight Line is a great business to follow. And if you look at what they've done, is they've been investing in service centers and warehouses for their less than truckload network for years when their competitors have been pulling back. And guess what? They've been winning a lot more business and getting a lot stronger. So I think it's really important to have that confidence in management and the moat and the strategy, regardless of the macro environment.
Old Dominion is ODFL for anyone who wants to follow that one. Worthington is WOR, and Costco is COST. Kind of a fun conversation here about moats, about management, and about price, and about investing in general. Todd Wenning, once again, the founder of Flyover Stocks. You can learn more about that at flyoverstocks.com. Todd, I had a lot of fun. Thanks for being a part of the 7 Investing podcast today.
Thanks, Simon.
Thanks, everybody, for tuning in to this edition of our 7 Investing podcast. We're here to empower you to invest in your future. I hope you have a great week.